Hello, everyone. Welcome to another Adam Live video. On today's video, I am going to be discussing angel investing and your self-directed IRA. So I wanted to do this topic today because angel investing, I believe, will be an important and very opportune option for self-directed retirement investors in the coming year because of the cost of cash. So before I get started, I'll spend some time talking about what is angel investing, how it works, and then talk about why I think it could become a really strong performing opportunity and option for self-directed investors in the next 6 to 18 months based off macroeconomic factors. So what's angel investing? Essentially, angel investing is when individuals or funds, investment funds, invest in early stage companies. So basically startups, basically businesses that have a business plan, not much proof of work. Maybe they have some clients or a little bit of revenue, but basically it's companies that have just started. Okay, so this is actually like pre-venture capital. Venture capital in most cases will invest in high growth, emerging businesses. Private equity, on the other hand, will tend to invest in more mature companies, companies that generally have at least 10 million in revenue, 2 million of EBITDA, earnings before interest, tax, depreciation, and amortization. So more mature, profitable businesses. Angel investments is the opposite side of the spectrum of private equity. It's super early stage companies where basically you have a business plan, you have projections, financials, budgets, maybe you have an employee or so. Again, maybe you have a couple clients, maybe your website's up, maybe your app is up, and maybe it's not, but you're looking for early stage funding. And the downside of angel investing is clearly there's a risk. Why? Because there's no revenue stream in most cases, right? There's no proof of work. So it's something that a lot of individuals want to do because of the fact that there is risk, but with risk comes high reward. And high reward means you have the opportunity to get into a high growth potential business at a early stage, literally on the first ground floor. So the concept of angel investing is, hey, I only need maybe to hit 1 or 2 out of 10 investments. So that's why the average angel investment is generally 10,000 to a few $100,000, right? I'd say the median is probably 25 to 50K. And what a lot of angel investors will do is they'll join communities and they'll pool resources. So maybe they'll get 10 or 50 or 100 angel investors to each put in maybe 25, 50, 75, 100 grand. And then they'll do 10 to 15 investments with all the money. This way they have more cracks at the apple, right? It's the idea that, hey, you can't hit a home run unless you swing. Baseball analogy, right? We're dealing with the World Series. And you only can home run if you take swings. If you just stand up there and look for a walk, you're not going to hit a home run. So the idea is let's take more swings, right? Another analogy is NFL or NBA, even Major League Baseball drafts, right? The idea is the more picks you have, the better chance you get lucky on the next Tom Brady, right? Tom Brady was a 6th or 7th round pick. And the idea is the more picks you have, the more chances you have to get lucky on the next Tom Brady versus maybe if you just have 1 pick in the first round, that could be really good, but you don't have a lot of options. And I read somewhere that about 25% of all first round quarterbacks kind of fizzle out and don't become even quality starters. So from an angel investment standpoint, the more investments you do, the chances you'll hit that one big one, right? The next Uber, or the next Twitter, the next Facebook, so on and so forth. And again, it doesn't have to be that big. It could be a business where you invest 50 grand and maybe it's sold for $10 million in a 5-year period. You can hit multiple, essentially, monster, massive returns. And all you need is one or two to make it work. So you can do angel investments in an IRA or 401k. Obviously, you need to have a self-directed IRA to do angel investments, because if you have your money at Fidelity or Schwab, they're not going to let you do alternative assets. So you're going to need to move to a platform like IRA Financial, where we will facilitate investments into angel companies. Now, as I mentioned, the average investment is generally 25 to a few $100,000. So for most Americans, angel investments is a really nice opportunity. You don't need to have $1 million in your IRA to potentially invest in the next great American startup. So from that standpoint, it's really exciting. But again, there is risk. Now that we know you can do it, we know what an angel investments are, right? We know generally it's done by an individual, maybe a couple of family members, friends, or maybe a more structured angel investment community where you'll have a management or team of managers decide what companies to invest. And then the idea is that, hey, I'm going to take a bunch of different investments and I'm going to invest, and hopefully a few of these will hit and I can get 6x, 8x, 10x on my money, which is the goal for angel investments. You want to really hit the 10x mark, and the beauty is you don't need that much to do it. So generally these investments they're long-term, say 3 to 5 year hold periods. A chunk will just go bankrupt, right? You're just going to lose your investment. But the idea is that, hey, on the next capital raise, whether it's in 2 years, 3 years, even a year, if you invest at a $5 million valuation, maybe the next round there will be a $20 million valuation, and then maybe you'll even potentially cash out at that point, if not on a later round. So why do I think angel investments will be so rewarding over the next 6 to 18 months? Well, it comes down to money, right? During COVID, I can't tell you how many bankers told me, Adam, cash is trash. I don't need your money. Stay IRA Financial. We love you. You're a great company, but we don't care about your money. I got too much money. All this PPP money here. Clients, individual savers have more money than they ever had. Interest rates are low. Keep your money. But now cash is king. How funny times have changed, right? That's why it's a good lesson. Always think long-term and never turn away business, because everything's cyclical. So I can't tell you how many banks, those same banks are calling me now and saying, hey, we'd love your cash. We want it. We'll give you great interest rates. Give us your money. Why? Because saving rates have dropped. Interest rates have gone up. We're in a tougher economic macro condition. And cash is king now. So what does that mean if you're an investor? If you're an angel investor and these companies need money, you're going to get better structures, better rates. And when it comes to rates on an angel investment, it means you're going to be able to invest at a lower valuation. Meaning maybe 8 months ago, that company or those entrepreneurs, founders thought the company was worth $3 million. You may be able to invest at $1.5 million or $2 million valuation, or even less, because you have the leverage now. A year ago, 2 years ago, the entrepreneurs had the leverage. The founders had the leverage because there was so much cash out there chasing deals. Times have changed. Now, these entrepreneurs need to face a more harsh reality that cash is expensive, right? Raising money and using debt is way more expensive. A mortgage today costs twice as much as it did in February and March 2022. Getting a business loan can cost you 6 to 8%, or maybe it was 4 to 5% 6 to 8 months ago. So cash has doubled, meaning when these entrepreneurs need to go out and raise money, banks, not going to be an option. Even a venture capital firm is going to be a lot more diligent at that business and at that opportunity than they were 8 to 10 months ago. So that gives you, angel investors, a really, really exciting opportunity to get in there and invest at potential really, really attractive valuations. So cash is king. Okay. Now, if you have IRA money or 401k money, you have cash. So right away, you have the leverage. You have now moved up on that pecking order, and now you have the leverage over the founder. So So if the founder comes to you and says, hey, we want to raise $300,000 at a $3 million valuation, you have more leverage to say, well, we looked at your numbers and your projections and your budget. We kind of feel like a 2.1 or 2 million valuation looks better. And you'll have a better chance of making a deal with a startup founder or entrepreneur today than you would have 8 months ago. Okay. Now, how are these angel investor deals typically structured? Well, generally they're structured two ways. Straight up equity. Here's 50 grand. I get X percent of your business. Either these businesses are LLCs or C Corps. Rarely are they S Corps. Why? S Corp rules limit investors to 100 shareholders. There's only one class of stock and no foreigners can be shareholders. So most startups that are looking for cash from investors, third parties, will not use an S Corp. They'll use a C Corp or an LLC. Okay, and I'll get to the implications of both for IRA and 401k investors in a couple moments. But first, as I mentioned, straight up equity. The second is a convertible note, whereas I will give you this money as a loan. So here's the 50K, and it's a note, but I can convert it into equity at a certain point at my choosing. Okay, and you can structure these notes in various ways, and they're quite flexible. And this way, you have potentially funds coming back in terms of a loan, or if it's a balloon payment, which you can then convert. It depends on your relationship and your deal with the startup. But generally, those are the two ways these deals are done: straight up equity, 1, 2, convertible notes. Okay, so from a retirement account standpoint, what does it matter? Well, I brought up this 4-letter word quite a bit over the last 10 or so years that I've been in the business. UBIT, unrelated business income tax, unrelated business taxable income, UBTI, UBIT. It's an ugly 4-letter word. Why? It applies and potentially imposes up to a 37% tax, which is the trust tax rate, on income that's generated by a trade or business, like a restaurant, that's operated through a pass-through entity like an LLC. Okay. Now, I actually was in DC this week and on a conference, and I had a chance to ask members of the Ways and Means Committee, were they ever thinking of exempting IRA income from the UBIT tax? And they looked at me and they're like, no, we haven't really thought about it, but talk to us. We want to hear why. And I said, well, unrelated business taxable income was put in the tax code in the 1950s to basically stop businesses like McDonald's from opening up charities and running their business through charities and never paying tax, right? We all know charities like the Red Cross are tax exempt. They don't pay tax. So the idea was, hey, McDonald's set up a charity and started selling hamburgers and Big Macs through the charity, they would never pay tax. Sounds like a really good idea. So Section 512, 513, 514 were put in the tax code to basically say, well, if you are a charity and you generate unrelated business income, meaning income that's unrelated to your exempt purpose, like if you're a hospital and you sell, candy or cars or dogs, that's unrelated to saving lives at a hospital, that's fine. You can do it, but we're going to tax you and treat you like a business. And that's fine. Those rules made sense. The problem with IRAs is when IRAs were created by ERISA in 1974, IRAs are taxed like a tax exempt under 501. The IRAs don't pay tax, right? That's a main advantage of being an IRA investor is the income and gains from the IRA or 401k investment is not subject to tax. That's good. That's known as tax deferral, just like a charity. The problem is, unlike a charity, IRAs don't have an exempt purpose, right? The whole purpose of an IRA is to make as much money as it can. So you, as the IRA owner, will have more money at retirement, right? That's the goal. There's no exempt purpose. A charity has an exempt purpose, right? Whether it's education or helping sick people or whatever it is, it has an exempt purpose. IRAs don't have an exempt purpose, so it makes no sense. And unfortunately, what's happened since 1974 is that anytime IRAs or 401ks invest in an active business, whether it's a software company or a bar or a consulting company that's paid through an LLC, and LLC, think of it as like a pass-through, a funnel, no blocking. a UBIT tax can be applied if there's more than $1,000 of net income. Now, you may be thinking, wait, whoa, Adam. I have an IRA or 401k. I've invested in businesses like Tesla, Facebook, Google, Twitter at some point. Do I owe UBIT tax? Am I in big trouble? The answer is no. Why? Because all publicly traded corporations, well, at least 99.99, there are a few that are publicly partnerships, but even REITs that are deemed a trust are treated as a corp. Corporation, think of it as a big box. It boxes in the income, right? Corporations pay a 21% corporate tax rate. So there's no need to add a UBIT tax to a corporation because there's already a business tax. An LLC, think of it as a funnel. LLCs don't have an entity level tax. There's only a member shareholder level tax. So unfortunately, because the LLC doesn't have an entity level tax, this UBIT tax gets imposed and triggers a up to 37% tax on the business income associated with the IRA investment. So in sum, if your IRA invests in an angel investment and this business, because all angel investments are investments into businesses, not passive or charities or entities that generate passive income. They're businesses, right? If there's more than $1,000 in net income and these angel investment businesses or LLCs, partnerships, not C corporations, you may have UBIT on your hand. You may not even be aware of it. If you get a K1, you'd have to look and see if there's UBIT, and you have to go down to the bottom of the K1 form and see in a code U or V if there's UBIT income. Or you may just look if there's business income on box 1, but you're generally not told. And it becomes very difficult for IRA investors to know what the amount of the UBIT is, how to pay it, how to report it, which is a 990T. And then a lot of investors say, well, that's crazy. I would have just used personal funds. So going back to my point when I was in DC talking to members of the Ways and Means Committee, at least staffers, I'm just like, hey, there's $13 trillion of IRA money. Okay. A good percentage of that would invest in the next great American startup, which could employ tens of thousands of Americans if you got rid of this UBIT tax. Because there's a lot of IRA investors, when they hear about the UBIT tax, they don't want to invest in a startup that's operated through an LLC because they don't want to turn an investment into, or at least a tax-deferred investment into an investment that could generate up to 37% tax. Where if they use personal funds, their tax rate and the capital gains tax rate would generally be a lot lower. So that's the problem with UBIT. It's a unintended consequence, but it's been around 48 years, and there's really no good reason for it because, again, IRAs don't have exempt purposes. But putting that aside, if you're an IRA investor looking to do angel investments, you have some options. If it's a C Corp, you don't have to worry about UBIT. You're good to go. If it's an LLC, what's your options? Well, a lot of startups don't make money initially. So you may not have to worry about UBIT. This may be an issue more for a private equity investor or even a venture capital investor. But angel investments, generally these startups don't make money for the first 3 to 5 years, right? Most of them are heavy capital intensive and they're reinvesting in people, into technology. So there's not going to be net profits. That's why they're going to raise money and keep raising money to grow. So you may not be super worried about UBIT, okay, which is okay. Another option is you can do a convertible note, right? Equity could trigger a UBIT if there's more than $1,000 of income allocated to the IRA. But if it's a note, interest is not subject to UBIT, right? Passive forms of income like capital gains, interest, dividends, royalties, rental income are not subject to UBIT. So you can start as a convertible note and then convert it to equity before a sale, or maybe convert it and then deal with maybe 1 year of UBIT instead of 2 or 3 or 4 years. But the convertible note will give you that opportunity. So the main thing to look at is if you're an angel investor and using an IRA is obviously do your research. You have to understand that it's like Major League Baseball hitting. You could be in the Hall of Fame if you hit 330, 340 lifetime hitter, right? Tony Gwynn, the San Diego Padres, considered one of the greatest hitters of all time. He had like a lifetime batting average of like 335. That means every 10 at bats, he got out 6.5 times. So angel investment's a lot like being a Major League Baseball hitter. You could be a really good baseball hitter, major league hitter with a 10, 12, 13-year career, and be a 280 lifetime career hitter. That's pretty good. The average hitter is probably a 265 hitter. So if you compare that to angel investments, if you hit doubles and home runs 2 out of 10 times, you're going to do really well, okay? Because that 2-time investment, that 2 winners, could be 8, 10, 12 times X. That means you get 10 times what you invested. Yeah, the other ones you'll lose, right? You invested 50 grand in company A, you lost it. 50 grand in company B, you lost it. But company C, you got 7 times your money. It makes up, more than makes up for those losses. So that's the idea. You got to remember, you're going to have losses. It's like you're going to be, if you're a Major League Baseball hitter, you got to get used to striking out. You're going to strike out. But on top of that, you also got to think about whether the ultimate investments, and if you're part of an angel investment community, it's something you may want to ask, like, hey, are you looking to invest only in C Corps? Do you care about the entity structure? Are you going to force the entrepreneurs to move to a corporation? Some venture capital angel investors say, hey, you got to convert to a C Corp. We're not investing in LLCs. We don't want pass-through issues, whether it's losses or UBIT. We don't want to deal with it. Okay, so that's something that you may want to ask your angel investment community or your fund. They may say, we don't care. We're looking for the best opportunity. We'll deal with UBIT down the road. These are startups. If they potentially are profitable and there's going to be another capital raise, they're going to have to go to a C Corp anyways. So all that will be taken care of. And that happens a lot, right? A lot of these startups are LLCs. And by the next capital raise, they're a C Corp because a lot of venture capital firms, foreign investors especially, don't want to invest in U.S. LLCs. Why? If a foreign investor invests in a U.S. LLC and there's income, they'll have what's called effectively connected income, or ECI, which could require them to file a tax return. And foreigners do not want to file U.S. tax returns. They don't. You think we hate the IRS and are scared of the IRS? Guess what? Foreigners are scared 10 times more than we are. They don't want to be on the IRS's radar. So that's why a lot of startups that start as LLCs end up being C Corps, which is good for IRA investors or 401k investors because you don't have to deal with UBIT. So you got to remember that too. But putting it all together, cash will be king today and probably for the next year. Rates are going to continue to go up. Banks are probably going to and have been pulling back on lending. Capital is more expensive. Debt is more expensive. That means if you have cash in your pocket, and if you have an IRA, you're going to have cash in there, you have leverage. And leverage is probably the most important superpower you can have as an investor. Because that's when you can push back and talk to the entrepreneur and startup owner and say, listen, yeah, you may think this company's worth 3 million or 7 million, whatever the number is. That's the past. March 2022 is gone. That's long gone. That may not come back for a while. We're in a different world today, and this is the terms I expect. And this is the terms that I'm willing to invest in. And yeah, you're going to have to take a haircut on your valuation, but do you want the money or not? And that's what's happening. Okay, I've seen it from friends and family and some investment circles I'm in, especially in real estate, but it's trickled down to startups already. And I expect it to continue. I expect that trend to accelerate over the next 6 to 12 months, where you're going to see really good potential startups with really, really good ideas and interesting technology say, hey, we need the money. Like, are we going to get this done? So our valuation isn't as high as we thought it was now. But if we execute our plan and build our business, then that second round, we're going to get the valuation. And I think you're going to see entrepreneurs say, I'm going to bet on myself. And yeah, I'll take your money at this discounted valuation, but I need it. I need to execute on my vision, and I need to get this business going. So I think it's going to prove to be a really exciting time for angel investors. I think cash is king. IRA investors have cash. 401k investors have cash. And again, as long as you understand the risks and the fact that you want to probably try to hit 2 to 3 home runs out of 10, 20 to 30% hit rate is really good. And if you can focus on that and have, whether it's yourself or your friends and family or a community or a platform, if you feel good about that and are willing to lock up your money for 3 to 5 years, I think there's going to be some really, really strong returns over that 3 to 5 year period, not initially, but use the circumstances, use today's environment to your advantage, and push back on valuation. Just because someone says their company's worth X doesn't mean they're going to take Y. So push back. You have the leverage now as an investor. Cash is king. Okay, so that's really what I wanted to focus on today. Just kind of recapping everything. Hopefully you now understand what angel investments are. You now know that you can do it in a self-directed IRA or a solo K. If you're part of a business, more likely than not, your employer is not going to let you do employer investments with the 401k into startups. But if you have IRA money or you leave your job or you have a former employer rollover, you can roll it into a self-directed IRA and then make that investment. You have to understand, again, the risks and rewards, understand the proposition that you're probably only going to, maybe hit 1 to 3 home runs out of 10. But that could be good enough. And then remember, obviously, how you want to structure your deal. Is it a full-on equity? Is it a convertible note type thing? Last thing as an IRA 401k investor is that 4-letter ugly word, UBIT. Remember it. If it's corp, you don't have to worry about UBIT. How do you know it's a corp? You'll see Inc. at the end, or incorporated or corporation. You'll be seen as a shareholder. You're getting shares or stock. How do you know you're in an LLC or partnership? You're going to see LLC at the end. You're going to be treated as a member or partner. You're going to get units or membership interest, not stock. Okay. If you are investing into an LLC, you have to at least consider the ramifications of UBIT. Now, it may not be significant because most startups don't make money initially, probably for 3 to 5 years. So if there's losses or less than $1,000 of net income, you're not going to have UBIT because there's no income. So there's not much to worry about. But if there is going to be income initially, you have to understand the implications that your income could be taxed at a 37% rate. Now, if you have losses up front, so long as you file a 990T, you can then use those losses to absorb any future net income, which is super helpful. And then obviously understand the leverage position that you are going to be in 2022 going forward into 23 because of the fact that cash is expensive. Banks are tighter now. Cash is not as prevalent as it was when the government just pumped $3 trillion into the economy and everyone felt super rich and was making money off all their investments, and PPP and all this great stuff was flowing into our bank accounts. And yeah, we were dealing with COVID and that's kind of sucked being at home, but we saw our bank accounts rise, our investments rise, our home values rise. And, that kind of allowed us to absorb any of the frustration we had with COVID. So, but that's gone. The free cash is gone. Now, maybe the Biden administration will get that $20,000 loan payments out, but other than that, it's gone. We'll see what happens with Congress next week. There's a good chance Republicans take the House, see about the Senate, and that could obviously change the dynamics in DC in terms of policies and the like. So, again, I think this is going to be a really opportune time for angel investors over the next year or so. I got a question, so let me try to address it. Can one have all of these cash balance plan, backdoor Roth IRA for 6K and solo mega for 61? Do cash balance plan limit change with the arrangement? So yeah, cash balance plans are defined benefit plans. So there's different income limitations. A lot of cash balance plans have combo, a 401k component. So if you have a 401k component, yes, that 61K limit will be part of that component. But if you're looking for expertise, let me know. I'm involved with 2 companies called Pension Investors. They're in Florida. They've been around 40 years each. They have about 1,200 plans and some of the smartest people I've ever worked with. So we can assist you. If you already have a combo cash balance plan, talk to your administrator or your actuary, and they can assist you on that. But you'll probably still be able to do a Roth IRA even if you maxed out. You just have to do a backdoor Roth because if you're doing a combo plan, your income limits are probably above $214,000. You're probably going to hit limitations. So the Roth IRA still could be an opportunity, but you're just going to have to do a backdoor. So just looking at your question, the backdoor Roth will likely be an option for you. So thank you for that question. Thanks for everyone who joined today. It's another great reason to subscribe to this channel because I generally go live Wednesdays at noon Eastern, but things happen, right? I was in DC for an industry conference, and I'll update you. I learned a lot of stuff. I'll probably do a podcast about what I learned next week. Check it out on Adam Talks. That also drops on Wednesday. You know, some interesting stuff going on in DC. Some really, I think, important retirement legislation, Secure Act 2.0, that seems like it's going to get passed the end of the year. So I'll probably do a review on that next week on a podcast. You just kind of get your appetite wet in terms of what's in store, and there's some good stuff in it. So definitely stay tuned and check that out. But otherwise, have an amazing weekend. Thanks for spending some time with me, and hope you enjoyed today's video. Thank you so much. Take care.